42% of Robinhood users trade options without understanding how they work. 68% of retail traders lose money in forex markets. Yet personal finance gurus keep pushing the same tired advice about living below your means while the system actively engineers financial self-destruction. The real crisis isn't debt or lack of savings. It's that all financial decisions have been gamified to exploit cognitive biases, turning even risk-averse individuals into dopamine-chasing traders. Your roommate's compliance demands, that nagging FOMO, the paralysis between HYSA and stocks. Symptoms of the same disease. 1. Compliance theater, when personal finance becomes a corporate surveillance game. Your roommate's employer doesn't care about your trades. They're covering their ass from insider trading liability. But here's what nobody's saying: this is just the beginning. As finance and tech merge, we're entering an era where employers will demand real-time portfolio disclosures, already happening at hedge funds. Banks will adjust credit limits based on your trading activity. Experimental AI models track this. Social media activity will trigger compliance alerts. SEC fined a trader $5 for Elon Musk tweet reactions. The just fill out a form request is a Trojan horse. Once normalized, these intrusions will expand until all retail investing requires corporate pre-approval. 2. The HYSA illusion. Why safe money is the riskiest play of all. That friend keeping extra savings in a 4% APY account? They're losing. Not just to inflation, but to behavioral decay. High-yield savings accounts create false security. Funds are too liquid, too easy to raid for impulse spending. The one-year Treasury yield is 5.3%, yet 92% of retail investors don't know how to buy them. Every dollar parked in cash is a dollar not compounding in equities. S&P 500 annualized return, 10.26% since 1957. The real reason people avoid investing. Loss aversion is now weaponized. Banks bombard customers with FDIC-insured messaging while brokerages push speculative trades. There's no middle ground. 3. FOMO as a financial product. Reddit user Patrick TU1258 isn't struggling with investing. He's struggling with a system designed to make him feel inadequate. Brokerages use the same variable reward schedules as slot machines. Random wins trigger dopamine surges. Social trading platforms display top performers to induce envy. Even when those gains are fake or unsustainable, the next big thing narrative is pushed 24/7. Bitcoin, AI stocks, meme coins. Always another hype cycle. This isn't investing. It's behavioral conditioning. 4. The debt trap is a feature, not a bug. Ramesh Hariharan's article frames debt as solvable with smart moves. That's dangerously naive. Credit card companies spend $22 per year on marketing, more than the GDP of some nations. Auto lenders now offer 84-month loans, up from 48 months in 2009. Student debt is structured to keep borrowers in perpetual repayment. Income-driven plans often increase balances over time. The system wants you in debt, not because it's profitable, it is, but because indebted citizens are compliant citizens. 5. The coming crackdown on retail freedom. Prediction: within 5 years, regulators will impose sophistication tests for all non-retirement investing. Pattern day trader rules will expand to all margin accounts. Options trading will require proof of capital reserves. Cryptocurrency purchases may face income-based limits. The for-your protection narrative will justify locking retail investors into government-approved safe assets. Your roommate's compliance form is a preview. The escape hatch. None of this is accidental. But there's a way out. 1. Automate real investing. Vanguard plus auto deposit beats 99% of active strategies. 2. Delete trading apps. Every notification is a psychological attack. 3. Treat debt like a biological threat, because neurologically it is. The financial system isn't broken. It's working exactly as designed, to keep you chasing, losing, and borrowing. The only winning move is to opt out.